Us right now is Charles Schwab, Senior Vice President and Chief Investment Strategist, Ann Sonders. Ann, it's great to see you. Thanks so much for joining us.
Thanks for having me.
We were just talking in the commercial break about how earnings are doing really well.
Yeah.
Earnings up 15% for the first quarter, revenue up 6% for the first quarter, and yet retail not participating.
So actually, the consumer is in okay shape here. Certainly, parts of traditional retail, bricks and mortar space is beleaguered. But actually, if you look at retail hiring, it hasn't slowed that much, and that's because more boutique areas are picking up some of the slack represented by some of the bricks and mortar. We're just way overstored in this country. I mean, the average number of square feet per member of the population is, I don't know, 6 or 7 times the global norm. So we're now just seeing sort of a rush to consolidate, and I think it's been a long time coming. So
you look at the backdrop for stocks, which are the fundamentals, earnings, and the backdrop getting better despite the retail story.
Yeah. So not only did we see a much higher beat rate for bottom line in this quarter, but we saw a higher beat rate for top line, too. So I think what we're finally getting is a nominal story, both in terms of earnings, but also the economy. And I think that's been the more important backdrop for why the market has done well. There's so much focus on whether it's policy related. I think that is a small component of it. I think that helps explain some of the spread between the soft data and the hard data. But it's the actual kickoff in the hard data, the improvement in global growth, the improvement in earnings, which in many cases predated the election. I think that's been the most important support and underpinning for this latest move in the market.
Well, your point about the consumer is interesting. The consumer's in good shape, but they're just not spending their money at malls. And we're seeing stores close left and right. What retailers are capitalizing on this strong consumer at this point? Who's doing well?
So, I don't cover individual companies, but I would say that one of the trends that I think is most impactful right now are sort of experience over traditional goods. Clearly, the consumer right now has the ability to go online, not only to shop, but also to price compare. So I think one of the biggest forces that's important is that this is disinflationary more broadly. It's not just the Amazon effect, but I think consumers are, in many ways, just much smarter. They're smarter in terms of how to be consumers, but they're also smarter in keeping discretionary consumption in line and not having it rise off the back of higher debt burdens. So I think that elongates the cycle here. It may not mean we get the pop in the economy related to the consumer like we have in prior cycles, but I think we have a much smarter, healthier, still in a deleveraging mindset consumer.
That's a good point. What about oil? Oil is up 3%. We've been talking about this earlier. Saudi Arabia and Russia, the ministers there said that they are agreeing to an OPEC-led production cut. That would be extended to 2018. Your take on that? 3.5% higher on oil right now, Ann.
I think we're probably somewhat range-bound. I think we get news like this that shoots us up in the short term, but I think we're sort of in this $40 to $60 range, which is actually a bit of a sweet spot because it's certainly high enough that it's above break-evens across the board, certainly for the shale producers, but low enough that it still is supportive of the consumption side of our economy. So that, if I could divine where oil prices are, it sort of stays in this range around 50. I think that's the best environment.
Liz, if I just jump in, I heard a number last week, the sheer volume coming out of U.S. equity mutual funds and ETFs and going into international. It was just an astounding number. Have you seen that in your experience?
Yeah, we have, except
in emerging markets.
Keep in mind that flows into non-U.S. have actually been stronger consistently in this entire market, even if you include ETFs. If you just look at domestic equity flows and you include ETFs, which has obviously been much more popular than traditional mutual funds, even inclusive of ETFs, on a net cumulative basis, not a single dollar of new money has come into the U.S. equity market since '07. So that's a remarkable sign.
Is it the retail
skepticism.
investor doing this?
Yeah, if you look at the spread between institutional and retail has consistently been sort of draining from U.S. versus international. Now, exposure to equities is up by virtue of the fact that the exposure that investors already had to equities has appreciated so significantly. But this is not a new story of limited enthusiasm for the U.S., although it's a newer story for the increased enthusiasm toward non-U.S.
By the way, that's the top story in the Journal today. Mutual funds lost as much as $5.4 billion over the past 5 years from soured investments in Puerto Rico bonds. That's the top story in the
That's the
journal.
muni bond
That is, yeah,
horror
because
story.
when you have 0% interest rates, you're looking for yield. They went for yield in Puerto Rico, 14% or something, and they got burned. Real quick, Liz Ann, looking at this market today and what we've seen since Election Day, would you put new money to work here for the long term?
I'd be a little bit more careful putting money to work here. We have an overweight to U.S. large cap, and that move recently was to reflect a little bit of a desire to be a bit defensive. So I think we could get some bouts of volatility, but I think it's in the context of an ongoing secular bull market that I don't see its finale anytime soon.
All right, we will leave it there. Liz Ann Sonders, great to see you. Thanks so much. And by the